As we were starting the show, there's lots happening in the unlisted universe with the angel tax.
That's where the headlines are. That's where the buzz is and the halchal is, if I could borrow a word from Hindi, because we finally have these long-awaited rules on valuations. I just want to jog our viewers' memory to sort of put things in context, and then we'll get in the experts as well. So what has happened today? What has happened is that the government has notified the rules that will determine how you arrive at the fair market value of shares while assessing the levy of angel tax. What is angel tax? Let me take a step back. Essentially, in Budget 2023, the government said that any equity fundraising that a startup is doing, unless and until that startup is a DPIIT listed, government listed startup, any other startup that's raising equity from foreign investors will be subject to this tax. In any case, if you were raising funds from domestic investors, then the consideration that is above the fair market value, that was subject to tax. It was treated as other income, and there was regular income tax on that, corporate tax that had to be paid on that. The budget expanded this to include foreign investors as well. Subsequently, we had a couple of notifications coming in. Some entities, certain category of funds were exempt from the purview of angel tax. These were, for instance, sovereign wealth funds, foreign pension funds, and what is known as broadly held funds, where the number of investors is above 50. So certain categories were exempt from the purview of angel tax. So were certain jurisdictions. The government had come up with a list of 21 countries, 21 jurisdictions. And if you were a broad-based fund or a pension fund coming in from these 21 countries, then you would be exempt. However, these exemptions didn't make up for the bulk of the inflows that were coming in the startup world, the private equity inflows, the angel and the VC fund inflows that were coming in. So the widely awaited valuation rules that will apply to everybody who's not exempt, they have been released today. Now, what are these valuation rules? There are two rules that were in existence for domestic investors. They've been outlined for foreign investors as well. That's the book value formula. And there's a formula to it, which will flash on the screen in just a bit. It's sort of based on your assets, liabilities, your total share capital, the value of the share itself, the face value of the share. So that's the first one, the book value formula. The DCF method, discounted cash flow method, that was in existence for domestic investors. Now it will be applicable to foreign investors as well. However, the new thing is these 5 new valuation methodologies to arrive at the fair market value of shares the government has now introduced. The comparable company multiple method, the probability weighted expected return method, the option pricing method, milestone analysis method, and the replacement cost methods. These were not sort of introduced earlier, but they have been introduced now when you want to arrive at the fair market value of shares of a unregistered startup. Not just this, the other interesting aspect is that the government has given a 90-day window period, and basically what it has said is that there can be benchmarking done with a deal. So let's say that there is a specified venture capital fund that has done an investment in a company, and then there is a subsequent investment that happens. If that subsequent investment is in the 90-day period and the subsequent investment, the value of that investment does not exceed the value of the previous investment, then the earlier benchmark valuation can be used for the subsequent deal as well. And the same applies, the same 90-day window and the consideration value, that applies in case you are getting money from an non-exempt or a non-qualifying entity. Let's actually pull up this. I'm just trying to make it simpler by showing a simple example. There it comes up. And this is actually an example that's been given out by the tax department itself. So I'm literally quoting verbatim. Suppose you are a startup and you raise 50,000 rupees by issuing 100 shares at a price of 500 rupees per share. So you are raising 50,000. Now, within a 90-day window, if you raise shares from another entity, another venture cap fund, if you do that in the 90-day window, and if the consideration is the same, it's less than 50,000 you're raising, less than or equal to 50,000, then the valuation that was applicable to the first, which is 500 rupees a share, can be applied to the next one as well, which is 500 rupees a share. So that valuation holds. Similarly, take the same example. If a deal has been done with a qualified fund or a sovereign wealth fund, then in that 90-day window, as long as the total consideration is the same, then that deal benchmark valuation can be applied for another entity where that entity may not be exempt. It's not part of the 21 jurisdictions list. Slightly complex, but trying to simplify what all the notifications say today. But let's try and understand the real implications of this. Does it soften the angel tax blow? That is the million, or should I say billion-dollar question. To take the discussion forward, today we have with us Girish Vanvari of Transaction Square, as well as Dinesh Kanabar of Dhruva Advisors. Gentlemen, thank you so much for joining. And I've tried my level best to make it a little simple for our viewers to understand. This is a highly technical matter. But Mr. Kanabar, let me come to you first. What have you made of these 5 valuation methods, and what do they mean to the startup world?
Surabhi, thank you for having me on this. And if I can just make a couple of quick remarks before I answer your question on the valuation rules. So yesterday, there was a new report which came out, which was doing a survey on the startups around the world. And it came back to say that the returns from Indian startup are the 4th safest in the world. So apart from USA, UK, etc., they've come back to say India is the safest jurisdiction for startups. At the same time, we have been seeing a huge amount of difficulties which people have in raising funds because the valuations have been going down, etc., etc. So they're living in a very dynamic situation. And I'm reminded, actually, Surabhi, of Gulliver Travels, where you have a giant which is being sort of chained by a small dwarfs, which are the regulations. And I'm glad that some of these are being removed and the giant will be allowed to wake up. So overall, to begin first, a very, very welcome change. It's very much accepted that the valuation which traditionally applies to an organization, which is purely DCF, which is purely on the basis of book value, etc., cannot apply to a startup. There are different considerations which apply. And what has now been provided, first there was an earlier notification, as you rightly mentioned, which said that if you are a sovereign wealth fund, etc., you are an exempt entity. So one is the investor being exempt. Second is the recipient being exempt because it is recognized by the government, etc. And the third was if you are coming in from 21 jurisdictions. And those jurisdictions, as it happens, Surabhi does not include the likes of Mauritius, Singapore, Netherlands, from which bulk of the investments come to India, nor Cayman Islands, from where many of these funds are set up. So if you are coming from these 21 jurisdictions, and you are a specified entity, which is a broad-based entity, then you qualify automatically, you are out of the regulations. If you do not, and that's what we are presuming in this case that you are not, then you go up and say that are you complying with the valuation regulations. And there are 5 different bases which have been provided, including the fact that if one of the investors happens to be from a regulated jurisdiction or is a qualifying entity, and there is an equivalent consideration of an investment by an unregulated entity, then even the investment by an unregulated entity would qualify. However, I can't understand, for example, the point which you made earlier, the example which has been given, that if you have a small investment from somebody else who is a qualifying entity or is from a qualifying jurisdiction, and another investment is made by a non-qualifying entity, but it exceeds the amount invested by the qualifying entity, how would you break it up and say, no, this does not qualify? So leave that aside, that's one. Now, that apart, I think the methods which have been provided now, which is the options price, the multiples, hopefully fits within the overall gamut and therefore is a sea change and better than where we are. The only challenges which you have are twofold. First is that many of the startups do not fall within any of these categories. So, for example, you don't have a comparable investment because it's something which is a new idea. That is what a startup is all about. Or for example, you are raising monies which are more than what you raised from a qualifying entity. And then finally, we have this challenge would be that at the end of the day, valuation is subjective. You have got a valuation within the 90-day period. Will the basis of valuation be challenged by the tax office or will they accept it? Those are the implementation challenges, but otherwise a very, very welcome step forward.
Do you think, Mr. Kanabar, that the entire pushback that started when this amendment was introduced, in the finance bill, the pushback was that this will make the funding winter even worse. It will make it impossible, near impossible, for Indian startups to get foreign capital. To what extent do these new valuation rules address that?
They address it to a great degree, Surabhi. Let's not run away from the fact that these valuation rules allow a merchant banker to pick up one of the 5 specified methods and come back and say that, yes, following this particular method, I believe that this is a fair value. And therefore, the ability to justify today is far, far better than what it was. Remember also, Surabhi, that the draft rules which had come up did not deal with convertible preference shares. Now we also have within the mix a convertible preference share. And we also have a 10% zone within which if you are falling. So three things put together, all of these things put together, really addresses the issues, not all of it, but bulk of it that we are looking at. As I mentioned earlier, at the cost of repeating, Surabhi, the challenges that we have is not every startup is susceptible to a comparable method or can fall within the 5 methods. And the devil is in the implementation. The tax office sort of then accepting the valuation report, which has been given by a valuer, and not challenging it to say that this is not something which we accept. But overall, a very welcome step and does address significantly some of the issues which have been raised earlier.
Okay, good to hear that. Let's bring in Girish as well. Girish, would you concur? I don't know, what have your clients been telling you over the past couple of months? As I think a lot of people have been waiting very carefully to see the fine print on this. We have the fine print today. Your thoughts?
So actually, if you look at the rules per se, the rules is as per the draft rules which were put up for circulation. So it's not different. There's only one change. This covers CCPS. The draft rules did not cover CCPS. So this is along expected lines. What is keeping people bothered, worried is the past. So if you see, a lot of funding happened over the last 3 years, which happened at different points of time at higher valuations. Now the funding winter, as you said, the valuation has corrected and it is on the downward trend. In that case, how will the tax office look at the old valuations done, the old issues relating to angel tax in light of the funding winter? So that's one thing which is a worry, irrespective of these rules. As far as these rules are concerned, what I felt is that they are absolutely comprehensive. They cover lots of situations. How will this be interpreted in terms of what is milestone analysis in the Indian context? What is milestone analysis globally? How will this work out is something which time will tell and time will play out. But really, in all, a very comprehensive set of guidelines which are announced. Now, should that list of 21 countries be extended to include other jurisdictions which are robust enough for investments into India? That's a debate, and that's something which the government should think through, like having a Singapore in it or other financially strong jurisdictions, which are a big route to invest money into India at this point of time.
Okay. Gentlemen, just on a side note, when we have you here to discuss angel tax, but Mr. Kanabar, I just want to get your view on a different matter altogether. Permit me this bit of out of syllabus, but it's news that will be coming in shortly, because our colleagues in Delhi are also looking at the GST rules when it comes to online gaming and casinos. And we've seen what's happened yesterday with that tax demand of nearly 17,000 crores going to Delta Corp. And the understanding is that this may be the same route that's followed to other entities as well. The government seems to be of the opinion that they will follow the same route that they've taken in the Gamescraft case. And that matter is now pending in the Apex Court. So just because this is news that's coming in, even as we speak, it'll be on the tickers shortly. Your thoughts?
Yeah, so if you recollect, when this whole issue on GST on gaming happened, and there was a pushback at that point of time when the amendment happened. The Revenue Secretary was on CNBC, and his point really was that this is how the law, in his opinion, always stood. So when he was being criticized for an amendment, he said this amendment is not what is a new thing. This is what it always was, notwithstanding that there was a High Court decision which said that it did not apply in the manner in which the government then amended the rule on a gross basis, etc. And now they have gone ahead and said that not only did we mean it, but now we are going ahead and issuing notices. And that's going to be a big challenge. So we have the law itself and the interpretation of laws. And yesterday you had a couple of experts on your channel who very elusively mentioned why this is not a correct way to interpret. And second is applying it retrospectively, because when you make a law and then you say that, no, this is what it was always meant, then whether you use the word retrospective or not, it is being applied retrospectively. Goes back to the commitment which the government has given on the floor of the parliament, that it will not introduce laws retrospectively. So the government is welcome to make a new proposition. Whether it impacts the gaming industry or not is a separate issue, and whether we want employment to go away from India to Singapore, UAE, etc. again is a separate matter altogether. But be as it may, if the government in its wisdom chooses to say that the GST should be on the gross value, that's fair enough, but you can't make it retrospective, notwithstanding that is a high court judgment which is in your favor and which is now a subject matter of challenge. So it's a very broader issue, and I hope that the government recognizes that as it is looking at ease of business and as India has become a very, very attractive destination, there is a certainty which investors are looking at, and steps like these don't necessarily provide an assurance of there being stability in the tax regime.
Okay, interestingly put, Mr. Kanabar. Yes, the word retrospective has not been used, but the way the law is being applied seems to be retrospective. The new amended law comes into effect from the 1st of October. That is GST on real money games as well as in the case of casinos. Gentlemen, thank you very much. Tax definitely making big headlines this morning. Really appreciate you joining us on the show today. Well, the news updates are actually on your screens. We'll try and get our colleagues to elucidate further on this, the matter of 28% GST in casinos and online gaming. We'll take a break on that note. Up next, everything that's buzzing in the commodities universe with Manisha Gupta.